Hi everyone. So welcome back to our audit session. And today we will be talking about RMM in details, risk of material misstatement. So firstly, let's understand that how do auditors apply the audit risk model in the audit. So there are certain steps and certain procedures which are followed while applying the audit risk, while understanding the audit risk and applying the audit risk. So risks that are relatively pervasively related to the financial statement as a whole and potential with that affects the assertions of the financial statement. So there are certain processes that auditors develop throughout the audit. So first of the process includes the risk assessment procedures. We have been discussing this throughout the series from the beginning that risk assessment procedure is one of the most crucial phase in the audit where auditors tend to understand and determine the risks that might be present in the entity that they are auditing. After doing the risk assessment procedures, the auditor understands the internal control, like evaluate the internal control that has been designed and implemented. As I said you earlier also, design and implementation is the role of management, but auditor evaluates the internal control that has been designed and implemented by the management and document their understanding. After that, after understanding the internal control, auditor does the assessment of the risk of material misstatement. So risk of material misstatement, like which risks are base, elevated or significant depending upon the various circumstances. And after that, auditor develops the overall response to the financial statement level or risk. So what are the risk present in the financial statement level? So auditor develops the responses on this. So here to understand the overall responses to the address the RMM at the financial statement level, it may include the certain things that which we need to keep in our mind while auditing. So team on the audit engagement, who all are involved in the audit engagement, their professional skepticism, their experience and everything. Like staffs are the important role because they are going to do the field work, they are going to conduct the audit. So the team present on the audit engagement, the unpredictability to be incorporated in the selection of the further audit procedures. There is always the chances of the unpredictability present in the financials. So the presence of that, nature, extent and timing the audit procedures and accounting policies that has been applied by the entity. So these are few points that auditors keep in the mind while performing the risk assessment procedures. That is the initial thing that auditor knows or auditor keeps in the mind. So now we begin on our understanding on the risk assessment procedure in quite detail. So risk assessment procedures provide the basis for the identification and assessment of the RMM. So RMM is the sub part of the risk assessment procedures, and risk assessment procedure really helps the auditor to identify and assess the RMM that is present in the entity. So auditor here understands the entity and environment, like understand the business what client is into, and then after that they identify the RMM. So background of the understanding the entity and environment where the client operates, and then they gain the understanding of RMM. So so here I want to put a focus on that auditor needs to identify and assess RMM at two levels, at the financial levels and at the assertions level. At the financial level means financial level as financial statement as a whole and potentially which may affect certain assertions, and to the assertion level for which might include the class transaction or a disclosure of the financial statements. So as a financial statement or whole, or certain assertions that might be included in the financial statements. So in both the cases, auditor needs to identify and assess the RMM. So what is the procedures to what is the procedure that risk assessment procedures include? So first is the walkthrough. Whenever auditor starts the risk assessment procedures, they perform the walkthrough. So walkthrough is a transaction. Following a transaction, we take a transaction of the account of the head of that we are understanding, and following the transaction and tracing the processing of the through the entity's information there, and the way that is reported in the financial statement. So here in walkthrough, we take one transaction of the area that is associated with risk, and then we understand the flow of the transactions. We trace the flow, like what all the procedures are performed to reach the documenting that amount in the financials. So it is basically understanding in the entire process, walking through the process by process to understand the steps, is to understand the controls, to understand the segregation of the duties. All those are involved in letting that amount in the financial statement. After walk through, the analytical procedures is performed. So in the analytical procedures, it is the identification aspect where the auditor is unaware, and they may assist in RMM. It may include may analytical procedure may enhance the auditor's knowledge on understanding the client's business and significant transaction, and also the data aggregated to the high level, and the which are in which material misstatement may exist. So in the analytical procedures, and auditor performs certain things. So to begin with, it's firstly understand the variance compared to the previous year, like why any area is highly fluctuated, if there is any abnormal amount, if there is any abnormal entry that has been done in the financial statement, the reasons for that, and that may have the scope and that may have the impact of the risk in the financial statement. So analytical procedure is one of the part of assessing the risk assessment. Then inquiries of with the management, internal auditors, TCWG, and other persons with the entity. After that, auditor also performs the inquiries with the senior team members to understand the internal control, to uh, understand the developments in the company, to understand the long term prospects, and to understand how and what methods company are going to follow to achieve the target. So all these understanding is very crucial to understand and to gain the knowledge that what different tasks, what abnormal task is happening in the company, and what areas need to get more focused. So this is one of the uh, crucial part, I would say, because to discuss with the management and the senior level team members is always important to gain the prospect and to gain the understanding of the long term business requirements, and how the entity, how the client is going to achieve that. After that, if there are certain inspections and observations that auditors need to keep noted down and documented properly throughout the audit. So this was something auditors performed initially to as a part of the risk assessment procedures. So here, if I talk about understanding the entity and environment, including the internal control, so it understanding the entity have four major aspects that needs to be kept in the mind. So if I give the mnemonic to it, it will be OPE and open. So in O, we understand the objectives and strategies of the entity and its related business. In P, we understand the performance of the entity. In the E, we understand the external factors such as industries, regulatory environment, and other external factors. And we understand the nature of the entity, such as operations, ownership and governance, investments, financing structures, and accounting policies. All these are involved. So objectives, performance, external environment, and nature of the entity. These four are the important things that should be considered while understanding the entity and in its environment. Now, how to understand the internal control? So, auditor's responsibility is to evaluate the internal control that has been designed and implemented by the management, right? So, in process of evaluation, auditors should keep in the mind that uh, those internal controls are preventive in the nature or detective in the nature. Like through that internal control, the misstatement is prevented automatically, or we have to detect that and we have to manually correct that misstatement in order to gain the financial statement true and fair. So this is the prime responsibility of the auditor to evaluate in the internal control, like what kind of controls are present. Is it preventive or is it detective? After that, understanding the design and implementation, as I said, to assess the RMM and to design the nature, extent, and timing. So, what type of controls are present once that auditor has identified? Then they further assess the RMM on the and the like fraud or errors that might be present and other circumstances that might be present. And after that, auditor design the nature, extent, and time of the further audit procedures, like when the audit is will take the substantial phase and when the audit is planned to be completed. All these are decided in the risk assessment procedures only. So here, a point that is to be noted that not all the clients' internal control are relevant to the audit. So while performing the financial statement audit, the auditor should consider internal control that is only relevant to audit. So there might be certain internal controls present in the company that might not be relevant in our financial statement, but that company has developed for its own benefit. So we should keep in the mind that we are auditing only the internal controls that is relevant to our to our audit. Few of the examples are controls relating to the elements of the five components of the internal control, controls relating to the anti-fraud program, controls related to the significant risk, controls related to the circumstances when substantive procedures alone will not provide the sufficient appropriate audit evidence, and other controls that the auditor determines to be relevant in the audit. So these are the few examples, but in the conclusive nature, I would say that auditors should be mindful while identifying the controls and audit and evaluate those internal controls which are relevant to audit. So there are few approaches that auditor uses to uh, evaluate, understand the internal control. So one is the top down approach. So here auditor in the top down approach, firstly auditor takes the beginning as the financial statement level, where auditor understand the overall risk of the internal control. After that they focus on the entity level controls, and then they drag down like financial statement as a whole, then they drag down, come to the down, like top is a financial statement, then the second phase they come down to the transactions balance or disclosures with their which are the relevant assertions. So after financial statement they see the transactions balance disclosures and their relevant assertions that might impact the internal control. After that, the risks that are present in the all those the control objectives the company has planned to mitigate the risk, and the controls that are actually present and that are actually happening in the company to mitigate the risk. So firstly auditors is the financial statement, then the assertions, transactions, balance, disclosures. After that the activities like the risks that are present. After that the control objectives, like what is the objective of the company to mitigate those risks, and the actual controls that are present to mitigate the risk. So There are two types of controls majorly, and first is entity level controls and the second is activity level controls. We will be discussing in this next chapter, but I hope you understood the risk assessment procedures and the understanding the entity and its environment, including the internal control. Thank you for the video, and thank you for staying connected throughout the video, and let me know if you have any queries in the comment section.